put your trades together, but there are definitely some nuances we'll cover today for credit spreads that I think will be important understanding when they are appropriate to use for a trade. Speaking of which, let's go ahead and take a look at what the agenda calls for today. So certainly we'll start by talking about, what are spreads, and when we'll kind of get into when do spreads make sense. We'll do a little strategy comparison, and finally we'll talk about what actually happens when we are trading those spreads. Before you do that, just a show of hands, how many people here have actually traded a spread before, whether it be a credit or a debit spread for that matter? Okay, good. So seeing a few hands. So this might be, and for those of you who haven't, just remember that when we talk about options, we're basically talking about, four basic positions, whether it's a long call, short call, long put, short put. And so we're basically just, when we do spreads, we're just combining a couple of those individual positions to make something different, which is, of course, a spread. So let's go ahead and talk about what spreads are to start off with. An option spread is simple, right? We're buying to open one call and selling to open one call, or we're buying to open one put and selling to open one put. So like I was saying before, if we're looking at the basic makeup of options, right? The very four basic elements of options, this is where you see how they're combined, right? We're buying one, we're selling the other, and that's really what a spread is. Different strike prices, they could have different expiration dates or both, right? Depends on how you're trying to structure this trade and really what your outlook is. But to make it simple, we're just going to talk about right now. Let's just say same expiration but different strikes. So let's take a look at a quick example of a bull put spread. Again, these are credit spreads. So our outlook here, if we're looking at a bull put spread, we're selling one 100 put at 320. We're long one of the 95 puts at 130 for a net credit of $1.90. So again, keeping in mind that these are credit spreads, so we're selling the spread, right? A bull put spread simply means we're selling a put spread, but we are certainly looking for things to move up from where we are. Again, depending on what your strike selection looks like, you may have a different perspective of where things should move, right? We'll get into kind of that in the money, out of the money kind of stuff a little bit later. But again, the outlook is bullish and neutral, right? And why do we say bullish or neutral, Matt? Probably because when we look at the way the spread is constructed, depending on where the underlying is at, yes, we could have a slightly bullish outlook. But certainly, if it was to be just a straight up bullish outlook, there might be better choices than a bull put spread, right? Because when we look at a spread, one of the things that we have to understand is that unlike an outright, a spread is going to be limited, especially when we talk about a credit spread, is going to be limited as to the amount of money we can actually make on it. And that limit is simply the maximum difference between those strikes of that spread. So this is a $5 put spread. The maximum value of this thing will be $5. Now, what can we make on it? Well, let's take a look at this math one more time, right? We paid 320, we sold it at 130, so our net credit, we get $1.90 on this particular spread. Because we're selling it, that is our max gain, right? We're going to be receiving $1.90. But as I just said, the maximum value of this particular spread is $5. So that means that our max loss on this is going to be that difference, that $5 less that credit of $1.90. So $3.10 would be our maximum loss. So as you can see, as I was saying before, yes, slightly bullish outlook, but probably if you had an extremely bullish outlook, you'd want to make more than a $1.90 on this particular trade, right? So as you can see, there right away you can see a limitation of this strategy that maybe if you do have that outlook, this might not be your best choice. The break even at expiration, that's easy. That's going to be the strike price of the short strike, subtracting that net credit. So again, if you look at that short strike, that 100 strike, less the net credit of $1.90, so 98.10 is our break even at expiration. And that is essentially, the bull put spread. Again, slightly bullish to neutral strategy. We're looking for things to either, move up or maybe potentially stay where it's at, but we're limited, right? We're limited from the aspect of $1.90 as our maximum gain, but at the same time, we're really limited on the max loss too, right? So one of the allures to spread trading is that right away, we know what we're risking and we know we stand to make on this particular trade, right? We know that if things go our way and we are correct, ideally, where would this be at the expiration? It'd be right at 100, so we wouldn't be losing too much on the upside. If it gets to that point and it expires, we get to keep that $1.90. The max loss is, obviously, if we're wrong and this thing continues to move lower to 95 and beyond, it'll be worth fully valued at $5, meaning that we lose at $3.10 because that's the difference between 5 and 190. On the opposite side, we can have a bear call spread. So again, this is something that's going to be bearish, slightly bearish to neutral, and much like that one we just talked about, if we have a substantially bearish outlook, there's probably better choices, right? But here we're actually selling the 100 call at 330. We're buying the 105 call at 150, and so we get a net credit of $1.80. So of course, what is our maximum gain? Well, once again, it's simply that net credit, right? That premium that we received for putting this trade on, that $1.80, that's our maximum gain. Of course, once again, this is a $5 spread. So that means that our maximum loss will be that $5 less that 180, which of course is $3.20. So again, with the spread, we've got the ability upfront to know what we stand to gain and potentially what we could lose. So it does make it a little bit easier from a risk management standpoint. The break even this time is going to be that strike price of the short plus the net credit. So we're short the 100, right? We add the $1.80, and so our break even is 101.80. So again, this is a bear call spread. We're selling the call spread. We're thinking that things will probably drift lower, maybe stay somewhere where it's at. We're hoping that, of course, ideally, in this scenario, it would expire right at about 100. So we wouldn't lose out on potential more gains on the downside. Obviously, if it gets to that 105, that strike that we're long, that unfortunately would be the maximum gain for this particular spread, and we would lose $3.20 on it. So again, I think there's a lot of reasons why we want to trade a spread versus an outright, but certainly the first one that comes to mind is the ability to immediately know what your risk is, right? We know what we stand to gain by understanding what that premium is that we're receiving, but we also know what we stand to lose because we understand that the maximum value of that spread, what that is, and what that difference is between the premium. So I'm sure I've skipped some things or missed some things, Matt. I'm sure you've got some things to add here. What else would you like to add to these two spreads?
Yeah, I mean, I think the main thing to understand about them, and sometimes I think people get a little lost in the idea of, am I preferring to do calls or puts, or should I be doing a bear call spread versus a bull put spread? And what really is important to understand about options and parity, and Albert's very familiar with this topic, probably used it every day of his life for many, many years when he was making markets, is that these can be interchangeable. And really, what you should be focusing on, in my opinion, is how aggressive or neutral or conservative do you want to be in selecting your strikes, because really that's what the difference is here. And the best way to kind of explain this to everybody, and I'm just going to pull up Active Trader Pro really fast, and I will use IWM just because it's the only major index here, major ETF that we don't have a another position in there, so I don't want to confuse everybody. But when we go to our profit and loss calculator, what I want everybody to see is kind of the following idea, which is that if you do a bull call spread or a bull put spread, these can synthetically be very. So we'll go in here, and let's just say we were to add in something that is relatively close. And I'm going to use just the next monthly cycle on this. I'll use the August 16th just as our go in there, and let's say we wanted to buy an at the money call and then sell one that's 5 points out. And we'll just use calls for both of these. And we'll use 645 and we'll use 410. I know it's a little bit higher, but we'll just imagine that we get 410 and we apply it on here. Now, what you're going to notice when we're seeing our graph is that this is going to look very, very similar to what we were just observing with our bull put spread, right? It's the same condition where If we start going down, yes, we're going to lose money, but there's a maximum amount of money that we can lose on this trade. And it's simply whatever the debit is that we put the trade on for. And then as we start to go up, we eventually run into our break even point, which is basically whatever we paid for the trade plus our long strike. So in this case, our long strike was the 220. So that's how we're getting there. And then anything above that, we start to make more and more profit until we hit our max. And that's obviously at the short strike. And that's the best we can ever do on this trade. So what if we were to flip this kind of condition around and say, well, what if we did a bull put spread? What would that look like? So we're going to buy, and let's use August 16th, and we just set this up really fast so everybody can see it. So what if we were going out there, let's say we were going to now sell the 225, and let's say we wanted to buy puts, and the math come out somewhat similar here. So now we're looking at a situation where we're doing a bull put spread. And what you'll notice on this one is that it's going to be very, very close. So our maximum loss here is 231. Over here it was 235, and that's probably just a difference of how I've entered the actual evaluation price is just slightly off. And then our maximum gain over here is 269. That's the best we can ever do from these trades. And that's the important part to understand about credit spreads is whatever, just like on a debit spread, the worst you could ever lose on a debit spread is going to be the amount that you're paying. While on the flip side, basically on a credit spread, we're the other side of the trade. So the best we can ever do is going to be making whatever we collected at the onset of the trade. And that's our best case scenario. If it were to all just expire worthless, we get to keep it all. Notice that we can make up to 269 here. And on this particular trade, we're at 265. And again, the difference here is just, the small differences in the spreads and how I entered the evaluation price. But synthetically, these are actually the identical trade. Now, the important thing to understand about this, and let me throw a column on here for a moment. What is our probability of profit on both of these? Well, what you'll notice is that as of today, they're about 50-50, but really what we have to do here to get an actual estimation is to go out and switch the date to the actual expiration date. And that's going to tell us, well, on that date, what is our probability of being above or below 222.35? And that's really what we're interested in, right? Is at expiration, are we going to be above or below our break-even point? And you'll notice we're currently at 220.36, so we actually have to go up 2 points, and that's why we're looking at probabilities here that are just slightly below 50%, which is why I think it's very important to understand just because you're doing a credit spread doesn't inherently mean that you're getting a more conservative trade. In other words, you're not getting a more probabilistic trade just because you're doing a credit spread versus a debit spread. What does make it more conservative? Well, what if we started to manipulate the strikes, and Albert, at risk of collapsing this thing here, what if we were to change these and make this, instead of 220, let's make it 215, and we'll make it 220 as the one that we're selling. I'm just going to leave the evaluation as is. Notice what's going to happen here. And we could do the same thing, but I'm scared to change both of them here because sometimes that stresses the program and it makes it crash. But if we were to change the strikes, well, now what have we done on our spread? And again, we could do the same thing if we were going out there and now instead of selling the 225, we'd be selling the 220 and then buying the 215. So we're putting it right there at the money. Well, now what we've done is we've increased our probability of profit from roughly 45 to now a close to 61% change. And the reason why is because our break-even point on this is now actually lower. That's the key point here. It's lower than where we're currently at, meaning that all things being equal, if it's roughly 50-50 and it's probably slightly skewed to the bull side just a little bit, if you look at a large number of occurrences, but the chances of us going down about the same as going up, but because we're a little bit higher right now, we're getting that higher probability. And we could make this even more conservative, of course, right? What if we wanted to go in there and instead of doing the 220 and 215, let's say we were to go out and pick something that's even substantially further away. The reason I bring this up is because this is how we get a more conservative trade, but there is going to be something we're trading off here in the meantime, and I'll show that in just a moment. So let's do the August 16th again. I'm going to do it from the perspective of what if we're selling a bull put spread? So what if we were doing, let's say 200 and 205? Now we're getting a decent ways away. And what we should expect is that our probability should be going up as we're seeing this. But you're going to notice something very, very important to understand about this. So when we do a spread that far away, and we're talking about only a month out, so that'd be a pretty significant drop. I mean, it's certainly possible in a month's time, but it would take a pretty significant drop for that to occur. Well, now we're looking at a situation where we're getting a 93% probability of profit. So 93% chance we make money on this trade. However, what are we giving up? Well, we're giving up our risk to reward ratio is what the answer is. Because the closer we are to at the money, or maybe even going in the money, we're going to collect more and more and more credit up front, whereas now we're collecting way less. Notice on these trades down here, we're making $3.10, $2.70. On this one up here, we're only collecting $40, and that's the best we can ever do on the trade. However, our distance between our strikes is still 5. So we could lose 500 minus whatever credit we collected. So now our risk to reward ratio is pretty out of whack, right? We're only making $40, but if everything goes horribly, we can now lose up to 460, whereas that's simply just not the case on this particular spread. In this version, we're actually looking at the opposite condition. We can make more money than we could possibly lose if everything goes perfectly. If everything goes wrong, yeah, we still lost $231, but obviously significantly less. So there's a natural trade-off, right? Between, well, how much probability of profit do I want? What's my risk to reward ratio? And how do I keep that in check? How do I keep that within the correct balance? And then, of course, just the simple idea of, how much can I actually make on this trade? And that's simply the amount of credit that we're able to take in. So a lot of this has to do with your strikes. And, I'm doing simple 5-point wides. It doesn't have to be 5 points either. You can do them much wider as you're starting to do them wider. Obviously, there's a situation there where there's less protection to the downside. For example, if I switch this from 200, well, what if we wanted to say 205? We find that to be a very, very credible support level. And I haven't even looked at the chart, so I'm not saying that it is for whatever reason or any particular reason, but let's just say that that's the assumption that we have in our mind, is that 205, that's a hard support between now and August 16th. So we like that level and we want to sell it there, but we don't want to pay, 63 cents and 5 points away. We don't actually think the short strike even matters all that much. I mean, first and foremost, you don't have to buy the lower strike. I mean, you could just sell a put. It's a little bit more aggressive, of course, but let's say you wanted to have some level of protection in there, which is generally the reason behind why you would do a spread. So maybe let's just say we wanted to widen that out. Instead of paying 63 cents, what if I switched it to 195? Well, now we're going to collect 65. So it's still pretty small. And even if we were to go out, let's say to 190, well, now we're only having to pay 30 cents or 28 cents to buy this. So this is going to start expanding our credit a little bit. However, now we don't have that same downside protection. And the biggest problem, let's go ahead and apply that one here, is now we have significantly more risk to the downside because our protection, our long leg is not kicking in as quickly. And however many points, we're just adding that to our maximum risk. So we went from a situation where we could only lose 500 minus the credit. Well, now, because the strike differences are 15, now we can lose 1,500 minus the $75 that we collected up front. So hopefully that's starting to make a little bit of sense. There, in any option strategy, whenever you're getting something, you're giving up something. So in the case of spreads, if you're moving away from where the action or the current price is, that's a better way of saying that, you're getting a higher probability of profit. At the same token, as you're doing that, you're shrinking the actual notional amount of profit that you can make, and you're also altering your risk to reward ratio from something that's more of a 50-50 split to something where if we think about this, I mean, we can only make 75, but we can lose close to 1,400. So that's a significant difference in that risk to reward ratio. So with all that being said, let me hop back over to
And
the
that's
slides
actually
here.
a good
Yeah, go
segue
ahead.
back to this question that Ed was asking, and that was, and I'd love to hear your thoughts on this too, of course. But Ed was asking, for example, if you're looking at a five wide spread, is there an amount that you should be looking at? Great question, Ed, because I think this is going to vary depending on who you're talking to, most likely. A lot of traders look for, maybe a 1-to-3 ratio. In other words, I want to pay out $1.50, but I want to make sure I can make at least 4.50 or something like that. I actually spoke to someone just this week that was more about half and half, 50-50. So they wanted to pay 250 with the ability to maybe make 250. So it's going to depend a lot on what it is that you're trying to do, right? If you're doing a debit spread and you're buying something, obviously you want to pay less and with the hopes of making more. A credit spread, you're probably selling something a bit higher, hoping to keep that and not worry about the smaller side of the risk. So it's going to be very dependent on what you are comfortable with, right? I don't think there's a blanket answer to say, oh, you should always look for at least 250 or more. I don't think that's true. I think it's whatever it is that you're comfortable with because, again, when you are choosing these and when you look at these prices, the prices are going to be determined by whether or not they're in the money. And Matt just illustrated the differences between in the money, out of the money spreads and how they're going to react and how they'll perform. So therefore, that's going to depend on what you are comfortable with, right? Is there anything you would add to that, Max? I think there's it's such an interesting question, but I think the answers would be if you ask 12 of us, you get 12 different answers.
Yeah, and I agree with that. I mean, there there's never going to be a right answer when it comes to options, right? Because it all depends on what the not just the end result as to where the stock ends up finishing, but also how does it get there? What's the pathway that it takes in order to get to August 16th? And depending on the different variations that it can undergo, it's going to have different responses, just not at the end, but also during the trade. And can you actually make it to the end because it's going really well or it's going really poorly, and maybe you're tempted to close it prematurely. Let me try to answer it this way because Amy was asking a question that's similar to that, which is, well, what if we were, instead of doing that spread widening, what if we just sold two of the 200, 205 puts and got nearly the same amount of credit? And that's an excellent point. So let's highlight what the differences are. And sometimes that's going to make sense as well. Because if you were to do this, what's nice about this is that when we look at the amount of credit that we can make from this, right? Well, what are we potentially making? Our eval price is still 40. So focus on this column right over here because the eval price, when you're doing more than one leg or more than one contract, it's still going to put it on a per contract basis. So focus on this column, DO, P&L. So we could make $80 from this, whereas we could make 75 from this one. So even just right off the bat, there's a $5 benefit in the amount of credit that we can actually take in right up front. Now, when we're looking at the scenario of, finishing above 205, yes, this one is clearly going to be better at expiration in all cases. So if we're at August 16th and 220, right where we're at, or, let's even get a little closer. Let's say it's 207. We make $80 here. We also make $80 up here. Where is it going to start going differently for us? Well, what if we didn't finish at 207, but let's say we finished at 199? And this is where that's going to be a little bit of a difference. So if we finish at 199 versus above 205, notice that, well, now suddenly this spread that has the 15-point difference is actually going to be a better outcome. They're still losers. They're both still losers, but you're taking on actually more risk here that's closer to at the money because being being in our maximum hurt or maximum loss scenario is that anything below 200, whereas our maximum loss scenario here is anything below 190. So it's not inherently better. It's, again, it depends on the yeah, and this is why it's so important when you're forming your outlook and picking a strategy, you have to have a very specific idea of what you think is going to happen. And once you have that, that's how you know, well, do I pick this one or that one? Can't answer that with the information I currently have. It's, do you think that we can go below 200? Well, if yes, but it's not going to be as bad as 190, well, potentially this one's better than this one. But if you think we're staying at, you know, 200 or above, or let's say if we were to go to 202, let's plug that in for a second. Well, even in this scenario, we're worse off by expiration with this one. But again, if we're staying above 205 at expiration, well, this one's just slightly better off. And there's going to be a point here where they start to get close to even, right? It's not quite there. All right, let's go to 203.8. So still not quite in there, but basically what I'm trying to explain is if you think it's going to really plummet, then potentially, this one is not as good because what's the problem with this one? Well, we can lose up to 1425. But if you think we're going down 20 points in just 20 points, and that's like one of the worst case outcomes for this, well, you can see that this one's actually slightly worse than this one, even though you're making more money on this one in the worst case scenario here, because the real problem, of course, is what if we go to 189? Well, in that situation, we're going to be at max loss here, and it's much greater. This one not as bad. What if we're at somewhere like 194? You can see we start to get pretty close here, and this is kind of the inflection point. But that's the difference between the two. So hopefully that kind of explains it, Amy. It's not that one is better than the other. Inherently, it's that they give you different profiles and different things that can occur depending on what happens to the underlying price. Let me hop back over to the slides here for a minute, Albert. And what I will do is kind of just take us through some of the, now that we've covered the mechanics pretty well and the strike end of it, let's go through and talk about when do spreads make sense? Why are we doing a spread versus, something else? So first of all, the starting point here is to just get a basic understanding or an idea of what are we trying to accomplish. So one of the things that we talked about here is generating income in a neutral environment. So that's why I said at the beginning, it seems like that, and it is. You're selling for a credit, you're collecting money up front, and hopefully at the end of the day, everything's just expiring worthless, or enough time passes and your strike hasn't been encroached upon so that you can eventually close that for less money than you initially sold it for. The basic concept behind selling options and specifically credit spreads in this instance. Now, again, the whole reason I just did that last exercise is to show you that, yes, just because you're generating income doesn't always mean you're neutral or even probable, because that's I think the underlying assumption that comes along with a lot of income-based strategies, which is, hey, I'm selling for income, I'm neutral here, and I'm also putting on a high probability trade. Again, the whole point of the last exercise was to show it depends on the actual strikes that you're picking. Now, you can also take advantage of a directional outlook. So in the example I was just doing, I was using a bullish version. We can do the same thing, selling bear call spreads. And again, depending on where we select those strikes, that's going to determine how bullish or bearish we are. As we're doing bull put spreads and we're going super deep in the money, right? That's going to make it more and more bullish, because what needs to happen? Well, what needs to happen is we need the price to rise to take that short strike out of the money, because that's the whole point. We don't want it to be in the money anymore. We want it to be out of the money by expiration. So we need, usually in those situations, a significant price increase for that to occur. So that makes us pretty bullish. We need a large move. Now, as we center in and we get closer to where the current underlying price is, that's going to make us more directionally neutral, but still overall bullish if we're selling bull put spreads, bearish if we're selling bear call spreads. Then as we start to go out of the money, we're getting more conservative. We're not collecting as much premium. the juice on the trade is not going to be as significant, but more than likely, we're getting an outcome that's going to be beneficial for us. The other things are defined risk. The whole point of this versus doing something like a just selling a put or selling a naked call. And this is kind of the main thing I want to talk about. Why would I do this versus just selling a put or selling a call? And it's an important point because actually, and I hate to be jumping back and forth, but it's better to just see it with an example. Imagine for a moment, and we'll go back down to the to this one right over here. So in this example, imagine if we weren't doing a, can get this to cooperate. There we go. Imagine if we weren't doing a spread. Well, think about the difference now between the two. What if I were just doing this, selling a put? There's some advantages here, right? And let me reset this and go back to August 16th. And the main advantage is that we're collecting a significantly greater amount of premium. And notice what's actually funny about this scenario, and a lot of people don't think of it this way. When we're looking at the probabilities, if we're selling a 225, which is slightly above where we're currently at, versus putting on the spread at 225 and 220, look at our probabilities of profit. It's actually lower for the spread than it is for the put by itself. And why is that? Well, our break-even point is lower. On the spread, our break-even point was 222.31. We actually need it to go up. On selling it, even a 225 put, we don't need it to go up because we're collecting, in this case, $7.60. And that means it can actually go down just a little bit, $2.60 past 220. And we actually break even on this. So our 217.40 is our break even, and that's where all those probabilities come from. So you're actually getting a situation with the naked put that is more probable. Well, what's the biggest drawback? Well, it's that defined risk idea. With the put in our disaster scenario, let's just imagine for a second that IWM is down 20% in the next month. It's not out of the question. It's unlikely, but it's not out of the question. That'd be about 40 points from where we're currently at. I know it's a little bit more, but let's just say 40 to keep the math easy. That would take us down to 180. It's a big loss. 37.40 is going to be the potential just at a 20% down move. Not even quite 20%, because I did 40 points. That would be actually 44. So we'd be taking us down closer probably to this if we did the full 44. With the spread, guess what? We have defined risk. Worst we could ever do is 231. This thing could go to zero. It could cease to exist by August 16th, and we're only losing $231. So that's the advantage of the spread versus the naked put. You're getting in the more normal scenario where maybe we're losing money, but it's not a ton, or maybe it went down or against us, but not by a whole lot. We could maybe even break even on this in a higher percentage fashion than the August 16th. But the spread version is the version where, hey, I think this is going to occur, but I maybe have some underlying fear, or I think there's a possibility that the doom scenario is going to play out. So I want to protect myself. And what am I going to give up? Well, I'm going to give up some of the potential credit. I'm only making 269 versus 760, but I have the ease of mind. I don't have to baby it as much, because a short put or a naked put, you have to be constantly monitoring this thing. And I'm not advocating that you don't monitor your spreads, but if you do nothing with this and even the worst case scenario unfolds, then we know at the end of the day, we're only losing the difference between the strikes and the credit that we collected. The one caveat I'll throw in there is on expiration is if somehow the price were in between these two, then you have to do some management, because you have the possibility to be assigned, which means you're buying 100 shares of the underlying, and then this one ends up expiring worthless. So you could take a large position into the weekend, and that could work out. It could not. It could put you in a really bad spot. So you have to be aware of that. All
Hey,
right.
you know what, Matt? I want to add one
Yeah.
element there, because I think this is important too, because Why would you use credit spreads? Well, another reason to use credit spreads is to reduce some of those option Greeks, right? So in that scenario, Matt was just showing us, if we're down 20%, I'm pretty confident that to say that volatility will also be up. And that's going to make your situation even worse, right? Being just short a put, you certainly being short an option, you don't want volatility going up. That's going to work against you. So if we're down 20%, not just the actual movement, but the movement and volatility will be very painful as well. With a spread, you're obviously buying one and selling one, so therefore you're not as concerned, or at least you're not as exposed to those Greeks, especially volatility in that scenario. So that would be another reason. Maybe you're trying to avoid some of those Greeks within your option position as well.
Yeah, that's an excellent point. And when you get that deep in the money, or and you're that close to expiration or on expiration, I mean, ultimately it's just where the strikes are. But Albert's making a great point for maybe not at expiration, but what about the pathway? We were talking about the pathway just a few moments ago. How does it get there? Well, I mean, even if we're down 10% in a short while, let's say it's even before, let's say it just coming into the beginning of August. Well, what you'll notice here is we have Vega, and let's see if this is going to cooperate with this here. And let's say we're not even down that much, but we'll say 200 because that's about 10%. Well, in these situations, what we'd be looking at is potentially a situation where the volatility aspect on the short put, in addition to the price being down, in addition to time going by, we could have volatility blowing out, and that could make these options significantly more in value because people are rushing out there to buy them. And maybe they're not as interested in the 225 at that point, but it kind of has this effect across the chain, right? When volatility goes up, it'll put it in a situation where you'll see not just one particular strike start to increase in value. It has an effect across the board and across the series. Whereas you'll notice that it's probably better to look at this from the perspective of what does it start out as? Well, we're negative 24 in Vega on a short put. Well, on a spread, we're also long 24 Vega. So our volatility risk is effectively nullified. Whereas with the short put, and why this is important, let's just say volatility, and I'm not even going to change the price. Let's just say volatility were to increase by 33%. Look what happens to the premiums and the options. That by itself, without the price budging, without a day going by, if volatility were to be 33% higher than where it's currently sitting today on both of these contracts, we'd be at 950 and 688 versus 760 and 491. So that's a very, very important point, and it's a great one to think about. And usually, what's also helping here, and that's one of the other negatives though about the spread, is when we go back and reset this, our theta impact. We're getting a lot of theta from selling a put by itself, 9.5. Whereas with the spread, we're not really getting that until the very end of the trade. You'll notice, let's say we were to stay right there. Well, if we were to go back out to August 1st, even here, Vega's not really helping us. And let's say we're looking at a situation here where we keep going. Oh, and you know what my problem is? It's because I'm underneath our break-even point. So let's actually put this at 225 because we need this to be there or above. And what will happen is as we get closer to that expiration date, well, now it's going to $2. And let's say we were to go another week, now it's 4. And as we get into the last week, we'll see it's even going to get bigger and bigger. You can see how important this is, especially if we're right there at the money. I mean, Gamma has a lot of work to do because their delta is still 50-50, and Theta has a lot of work to do because there's a ton of time value left on those contracts. So that's one of the negatives and the positives is, yeah, we get the nullification of our volatility risk, but Theta doesn't really start to kick in for us until right up in that expiration window. So it's a good and a bad. Right now, if it appreciates in our favor and time's going by, those are both good things. Volatility is probably suppressed. So there's still a possibility to make a profit on this. Let's just say, for an example, we go to 230, and that's by we'll do August 1st again. It's a pretty big move. Let's say volatility is even decreased a little bit. Notice what's going to happen. Well, we sold it for 269. We could buy it back for 104. So we could right there in that moment take a profit of 164. And sometimes you want to do that, right? You say, okay, well, I made, a good chunk of the amount that I can make on this trade. Do I want to just close it right now and take the risk off the table of us collapsing between now and my expiration? Or do I want to continue to see it, go, because obviously we're starting to get a decent data burn at that point. And again, there's never a right answer to that question. I think I should say this: there's never a right answer all the time for that question. Is what I mean by that, because any one scenario can go awry. A lot of people will tell you, hey, once you get too close to expiration, our gamma starts to go up. So small changes or smaller changes in this can start to affect our P&L. Like, what if we were to drop the next day to 225 and go back there? Well, notice what happened. Our profit shrunk a decent chunk, right? Because now our Theo price is 190, 260. What if the next day we were to go up a little bit more? So by Monday, or down a little bit more, now we're at 223. Well, now our profit shrunk to only $37. And I mean, unfortunately for something like IWM, as we're seeing today, I mean, this is possible. It can go down a significant amount. I mean, it was just up 4%, I think, in one day. It can, I promise you, go down just as fast. Or, think if you're doing the opposite version, which is the bear call spread. Think about if you had bear call spreads and, you sold them a few months ago and you're thinking, hey, these are golden, right? We had this perfect level of resistance, hasn't broken it. And then this ends up happening to you last week and to start off this week. Just imagine this for a second. So I know we've been thinking about puts, but imagine back in March or May, maybe you did it right here. Maybe you did it shortly after this expiration and you said, okay, yeah, let me go out 2 months to the July 19th cycle. We have this really firm level of support, or excuse me, resistance at roughly 210. And you watched it actually bleed down and time go by. I mean, you're thinking you're golden. And then boom, one day we went from 203 to 210. So that's 7 points. That's exactly what I just did in the other example. And then it didn't stop. And it went all the way to 224. So if you sold a call by itself, you're really, really hurting. At least with the spread, you had some protection to the upside. And this right here is a perfect example of why some people prefer spreads to just selling naked calls. And just for anybody that's not familiar, this level of resistance, I mean, it's gone on for some time. We haven't been above this level since 2022, the very beginning, and then we just barely went above it over here in the end of March. But we went from a scenario where we're at 203 to 225 in about 5 days. So that's a huge move, right? That's more than a 20% move in a week. So these things can happen, especially, small caps are maybe a drastic example because they tend to be a little bit more volatile than the other major indices. But this, or just think about individual stocks. Anybody needs an example of that one? Let's go think about what just happened with Tesla here.
The other thing too, Matt, is this is a great illustration of how upset you would be if you would have sold a put spread as opposed to buying a call, right? If you're actually looking directional, or if you have that feeling, maybe that spread is not what you're looking for. Maybe you need to have the exposure of just a one-legged or the underlying instead of having a spread on.
Yeah, I agree with that completely, which is, again, why we tend to say these are more neutral trades, because even though you can be directional with them, most of the time, if you're overly bullish or overly bearish, why are you doing this? Why don't you just buy a call or buy a put, especially if you think it's going to happen quickly? Because then if you get the move that you're looking for, you're actually getting that convexity, which means I'm paying $500 and maybe I can make 2,500 or 3,000, or, I'm making up numbers here, but 4x and 5x, those are very reasonable when you're buying calls and buying puts, especially in a lower volatility environment. which is, definitely a consideration. But the point here is the same thing can happen with individual stocks. We went from 196 on June 26th to 246, and this is more volatile even than the Russell. So that's all accounted for in the options pricing. But the point is, these big vertical moves do in fact happen from time to time, which is why some people prefer the spreads versus just selling outright naked calls and naked puts. Albert, let me pause there because I know we probably had a couple more questions come in. If not, I know we probably want to hop back in the slides here for a minute unless you had another idea.
No, actually, we did have one question I thought we should kind of discuss real quickly while we're on the subject here, and that is Ed was asking about should you be looking for certain widths of spreads, right? Should you be looking for a $5 or a $10, or should you look at $2 or $3 types widths? So I know you've got some thoughts. I definitely have some thoughts on that. My first thought is not really, right? It really just kind of depends on what it is that you're trying to do. In other words, when I was on the trading floor, anytime we saw like a spread pop up that was only two strikes wide, 9 times out of 10, that was actually a hedge for something else, right? It wasn't actually a trade that somebody was trying to do. It was just them saying, look, I don't want to pay a lot for some protection, so I'm going to do a super tight spread, and that's how I'm going to have my protection. On the other hand, you can get wider spreads, but the difference you're going to find out, I mean, there's a lot of nuances to those types of trades, right? The difference you'll find out is they're going to act differently, right? Think about if you were to do a two-strike wide spread, the delta on that thing is going to be very low because they're basically right next to each other. And so it's not going to move nearly as much as you might think it would. On the other hand, if you do something that's, 3, 4, 5 strikes wide, it's going to have a much different looking delta and going to behave a lot differently. So, yeah, I don't think that there's a concrete answer for that. I don't know what you think, Matt, but I think that it's going to depend on what your outlook is and what it is that you're trying to do with that particular trade.
I mean, I'll always circle it back to this, which is if you don't know, the best course of action is come on with your outlook first. And Amy, I see your question. I'll address that in just a second. Um, Come up with your outlook first, and then not just we're here today. Here's my expiration date. This is where I think it's going to be by expiration, but also how is it going to get there? Are we going to go up quickly? Are we going to grind there? I mean, you have to think about all those things. And then what you do is you take some different widths. If you're not sure which width to use, do what I just did, which is, well, what if I do one of the 205 versus the 190 versus two of the 205 versus 200s? I mean, I didn't immediately offhand, I had an idea of what would happen, which is why I was able to put in the different prices to show the point. But even I wasn't able to just automatically know, well, what would my profit or loss look like just right off my head. But that's the whole point of the tool, right? Which is you go in there and then you plug in, what if it goes this way? Okay, well, it's leaning me towards this side. Well, what if my outlook is not correct? What if my outlook does the exact opposite thing of what I think is going to happen, and the thing goes in the opposite direction and it's worse than I think it could possibly get? Plug that in and plug the pathway. So do this price by this date, this price by this date, and then see what the actual profit and loss will be, and then try to determine to yourself, well, what's the worst case for this one? What's the worst case for this one? Can I tolerate both? Can I tolerate neither? Can I tolerate one or the other? And then that's how you end up coming to the decision of, I want to use this width or this amount of contracts versus something else. It's just like when you're out there and we teach the calls class. Good question. Well, what do you think is going to happen in the best version? What do you think is going to happen in the worst version? Plug those in, see what your gains and see what your losses are. In other words, stress test the strategies and then determine, is there one of these that I absolutely can't tolerate? Is there one of these that's looking more attractive than the other? And then usually that'll lead you to your answer. As far as determining your outlook and the direction that you think the underlying is going to go, so we don't do that in the options classes, but that's what our technical analysis classes are going to be. And I want to clarify one thing, right? Nobody knows where the stock's going. Anybody that tells you that is probably lying. Now, you can have an idea, right? You can have a leaning, but from one day to the next, I mean, it's just malarkey if they're telling you that they know what's going to happen the next day. Now, some people tend to be right more than others, and I don't think that's purely luck, but it's usually because they have some kind of strategy or some kind of process for analyzing what stock price is doing. And for us, we tend to focus on trend here, which is okay, we're looking at least I'll explain my process here. We're looking at a monthly perspective, then we'll go to a weekly, and then we'll go to something like a daily. And what you're trying to understand here is there an overlying direction that the market is moving? And then, if so, do I want to jump on that trend because I think it's going to continue on in that direction? Now, that's the longer term this class because that's our technical analysis classes. But I would say up until recently on this thing has obviously been in a massive downtrend since 2021, but it's testing breaking out from that. So maybe we're in the process of a reversal. And is it a reversal or is it not? I mean, even right now, there's no way to know for sure. Typically what you're doing with trading is you're making an assumption and then you're using the technical analysis to react to how price interacts with your technical analysis assumption. Right. So that's kind of the idea. And the thing I would encourage anybody that's trying to do something like this, especially with technical analysis, is if you're working on your process or your strategy, start really small because it's probably not going to go well at the beginning. And then you want to fine tune it and say, okay, well, I've done this, trade 10 times because I based it on a breakout of this pattern. And every time it's not worked, or I'm using this collection of indicators, and every time I place a trade, it ends up going the opposite direction. What does that tell you? Well, you're probably not looking at the correct thing. So maybe that's where you want to fine tune it or tweak it all together and say, this is out, this is in. And then you're just looking for that mix of things that gets you a consistent result. And you're not going to win on all the trades. And it's a complete, misleading statement if you say, okay, I have this system, it works 90% of the time. To quote you what I tell people in our technical analysis class, the best day trader in the world, Steve Cohen, he ran a fund where he said his best traders were right about 50% of the time. And then his elite, once in a lifetime, once in a generation traders were making trades that were correct about 60% of the time on a percentage basis. But the best traders, there were a lot of traders that won 50% of the time and were off the fund within a short while because they didn't manage risk. Then there's other traders that won 50% of the time, but they had these, convex blowout trades, and then they did a really good job managing their risk when they were wrong. And those were the ones that stuck around for a year. And anybody that's not familiar, that he ran 0.72, owns the Mets, one of the most successful hedge funds in the world. So the point of that being is there's never a system or a concoction of indicators that's going to tell you, even I would say more than 55, 60% of the time what your outlook's going to be. It's either you're trying to get an edge one or two ways. Either you're structuring your trades in a way that they're very probable because you're either on the side of trend, or the way that the risk reward setup is making your trade likely to occur, or you're looking for the opposite typically, which is, hey, you're comfortable losing a bunch of times in small amounts, but you just need one of those trades in every 15 or 20 to be an absolute blowout winner. And then that's how you increase your profit. So there's all sorts of different strategies. And I'm sorry to go off on that tangent for so long, but I just wanted to address that because that is an important part of options trading, which is creating the actual outlook. Albert, I know we're running a little short on time here. Any other things that you want to talk about? Because I know we didn't really talk about expiration. I can talk about that if you want, or I wanted to give you a chance to jump back in though.
Yeah, I think we've actually, I was looking at the slides, we've actually covered a lot of the things that are on the slides with regards to strike selection and things like that. But I think really, if we want to talk about how to choose that strike selection and how to look for the right options, Ed was asking another question. Looks at options and he gets an idea, but the liquidity is just isn't there. And I think that's a very valid point because liquidity is going to play a major part in determining your success of your particular trade. Now, you could do some analysis and you could find out that, hey, I want to trade this over this time period, but if the option activity doesn't support it, you might want to reconsider that, right? And I think that typically, and you feel free to chime in on this one, Matt, but in my experience, at least, I found that when we're looking at options, of actively traded options, typically it tends to be a lot of the quarterlies or the shorter expirations that are the most actives. And that comes really from a standpoint of market makers and not really wanting to manage and hedge a position of options that are so far off in the distance because it creates a lot of complications and really those movements can make their, and overall holdings look a lot different. So they tend to stick to some of the shorter term type of things. And so I think that's where you'll find a lot of that liquidity. But do you have a different opinion on that, Matt, at all?
Yeah, no, I mean that's pretty accurate, I would say. And as far as the liquidity, it is an important part of this, especially in a spread, because anytime you add more layers onto a trade, the harder it is to exit it all as one trade. Now you could always potentially break it up into individual legs, and that does make it a little bit easier, but then you get slippage. And if you're doing this, a lot of times over the course of a year and then years, slippage can add up and it can put a serious dent in your probability, or not your probability, but your profitability. So that's an important concept of this, which is more of a general options trading concept. Does it have the proper liquidity to even do this type of strategy? And if it doesn't, then maybe you just have to say, hey, I love the setup, but is there a different way to gain exposure to this idea? Is there something I can just do with the shares maybe that has a better liquidity metric? Or is there another strategy that if I can put this on, I can more or less set it and forget it? Not set and forget it, but it doesn't need, constant adjustment. As far as definitely want to talk about, managing the strategies. And, as far as the dates, let me just say one thing about the expirations, and then I'll talk about this to close this out. The further you go out, and this is kind of the case with a lot of different options, the further you go out on a spread, the less sensitive it's going to be to the underlying movement, because the gamma is going to be smaller. It has more time to do its job. Now, that's a good and a bad thing. It's good in the sense that, well, if you're dead wrong, you have some time to have it correct and mean revert and hopefully go your direction. The bad, of course, though, is if you're immediately right, well, you're not getting rewarded for that either as much. So there's kind of the idea here, which is if you're doing a longer term trade, it's because your outlook needs to be longer term. You think it's going to take some time for it to play out. I don't want to be doing a 3 or 6 month or a leap on a breakout trade that I think is going up 10% in 5 days. That's stupid, honestly. It just doesn't make any sense if that's truly my outlook, unless I think that's a possible version, but I'm more convinced of another. Then it can make sense. I don't want to like pigeonhole it too much here. The shorter term, just like what we talked about on the longer, which is the shorter, the good news is it's really reactive. It's very sensitive. Gamma has a lot of work to do in a short amount of time. So it's either got to start moving that trade or not. So if you're immediately correct, you're rewarded for that more quickly. If you're wrong, well, you're getting punished for that more quickly. So that's the constant trade-off, and trying to find that balance between the two. That's what most people like to look at, which is why a lot of the trading is circled around 30 to 60 days. I say that as we're seeing people flood more and more into the retail trading, 0-day and weekly expiration options. Biggest problem there is, I mean, those have the most sensitivity, and you're either right or you're wrong very, very quickly. And if you have a poor strategy, you're probably not going to be trading for very long. I think most people doing that, I'd love to see the studies. I know that we're probably right around the corner from starting to see some hard data on some of this stuff. And based on day trading studies I've read, which in theory is less risky than options, I'd imagine that most people that are doing that at the retail level are failing, and they're quitting after a short while. Well, let's talk about what we can do to manage these strategies briefly, and then we'll wrap this up. So we can do three things basically. We can leave the strategy alone, which basically means we're doing nothing with it. That's one of the best things about a spread, is we can kind of do this on the winning and the losing side, and we kind of know unless it finishes in between those strikes, that can be a big problem. But as long as it doesn't do that, we know what the worst case scenario is for us. And then we just allow potential exercise and assignment to occur if we're between the strikes. We can close the strategy. This makes sense when we either have the profit that we're looking for, or we think, hey, I'm just dead wrong about this. Before it gets worse, let me close it out. Again, one of the nice things about the spread is that it's going to move somewhat slowly. So you usually have some time to change your mind, at least in comparison to a single leg option. And then there's adjusting the strategy, which is effectively altering your current position and either doing one of two main things with spreads. It's either usually giving yourself more time, saying, hey, I have the spread, it's in the money right now, but I think it's going out of the money. I was just wrong on the date. It needs a little bit more time. Let me try to roll this out, collect a little bit more credit, defend my position. Certainly a thing that you can do. And that's also one of the nicer parts about going with a wider strike selection. Well, what you could potentially do is, or a narrow one, you could make it wider. So you're saying to yourself, okay, well, I have this 205, 200. What if I roll out and then make it 205 and 190? So I'm not having to pay as much for the 190. Potentially you can, spread that out. You're taking on more risk. But if you're convinced, hey, we're bouncing now, I was wrong, now we're coming back up. And usually you want to see some kind of sign from that on the chart, indicating that, hey, it's not just a gut feeling, but there's actually some price action supporting me. That's another way that you can do it. You can also roll it up or down. What if you're at 205, 200? What if I go out two months and then roll down my strikes? So now the strikes that are in the money are out of the money, and I'm able to collect a credit. Again, always of the defending the trade. So that's a couple of the different things that we can do as far as the defense goes. And then the other thing I'll just point out, which is as far as the holding, not holding concept. And that's effectively that if we're looking to achieve our maximum gain on a position, you have to hold it through expiration. That's just the only way to do it. But remember, if you've made 400 out of a potential 500 or 400 out of a potential $410, you've made 95% of what's possibly there to make. Some would call this picking up pennies in front of the steamroller, because there's basically nothing left else to make on this trade. But it can, as we just saw, it can go against you very, very fast to the up and the downside. It occurs in both directions. So make sure you're aware of that. That's the cons on the left-hand side. A winner can turn a loser, even if it doesn't seem possible. I promise you it is. If you trade long enough and you do this for, even a couple years, you'll usually have one surefire. It was a great winner, and it'll turn into a loser. Maybe not even a huge one, but maybe a huge one. So that's one of the biggest things. And then also, if you hold it through expiration, you also always have that assignment risk. And that's what I'm talking about, falling in between the strikes or just going slow, a little bit below your short strike or above your short strike if it's a call. And now you have to worry about exercise and assignment into the weekend. And if you're doing that with a lot of contracts, probably the worst example I ever saw, somebody with a $50,000 account went in there and did Chipotle spreads that were $5 wide on a $1,500 stock, ended up with a $50 million long position into the weekend. Now, we managed it on our side, but imagine if your $50,000 account had $50 million of Chipotle stock and it's only down, 0.1%. I mean, you're wiped out. Now imagine it's down 1%. Now you're in the hole. So just be aware of that, especially if you're doing large amounts of contracts, which again, I would not encourage anybody to do at the beginning when you're just exploring the strategy. And then of course, the other option is, what if we just close the thing? I mean, the beauty is you can lock in the potential gain. You can then go on to see, okay, well, maybe I can make $50 more on this trade, but what if I close my trade, get that capital back and deploy it elsewhere where I can make even more than $50 remaining on the potential trade? The biggest issue with this, of course, is you're never going to see that full 100% or the amount that you initially collected. So that's pretty much it. I know we're 4 minutes over. Albert, unless you had any final comments here, I think I'm done on my end. I'll let you close this out.
No, I was just gonna say, one of the most painful lessons I ever learned in trading was not holding through expiration. I had a really good trade on. It was 50 cents from being fully in the money, and so I got arrogant and said I want to get paid the full amount for this because I did such a good job. Went out to lunch, took my friend out to lunch, paid for his lunch, came back, and it was some sort of tape bomb. And it was not only was it not at full, it was actually less than what I paid for it, and it actually finished up out of the money. So I lost everything on that particular trade. So yes, I've learned that lesson, and I certainly would encourage you to consider taking some gains when you have them, especially if you get, as Matt said, 90% of what you're hoping to get. It's just good, prudent risk management. But hopefully this has been useful to you. Again, this is not the objective here. Wasn't for Matt and I to say, hey, go out and start trading credit spreads. The objective was to give you the information and let you decide if this is something that fits into your toolbox, so to speak, of option trades. There's certainly a place for it and a way to use it. And there's certainly opportunities where it's probably not the best decision. So take an opportunity to look through it. As Matt said, ease into it. Don't go crazy the first few times you do it. But hopefully this at least gives you the confidence to go forward and maybe see if this is something that can be useful to you in your trading plan. Matt, always a pleasure to share the screen with you. Hope everyone has a great rest of the great day and a great rest of their week, and we'll see you next time. Take care, everybody.
See you next time, everybody.